if you can refinance anything that has collateral against it, you can pay off your non-collateral loans with a much lower interest rate. So if you have a car loan or a mortgage and you refinance those to pay off these credit cards that he's talking about, that could substantially reduce your payment and the interest rate that you're paying, and therefore help you out. Money can be complicated. Let a nerd help you. We're here to demystify the complex nature of money by getting you answers from financial nerds and whiz kids. Welcome to Ask the Money Nerds, a weekly segment of the Wealth Labs podcast where we answer your most pressing money questions. What is the quickest way to reduce debt? You're stressed, feeling anxiety about your payments, your loans, and your cash flow? Well, if you have more than one loan, this is the episode for you. Amanda, what's up? Why is every time I text you, it says Ananda? I have to, it thinks that I'm typing that. Is it my stupid thumbs or is it the stupidity of autocorrect?
It's the stupidity of autocorrect, because I was typing in the word paddleboard the other day and it corrected as paddle cord with a K-O-A-R-D. And I'm like, you're telling me that's the right spelling when I actually spelled it correctly? It's so bizarre.
How does it know I'm small town? Because every time I type F-O-R, it types F-I-R.
Oh.
It's like, no, you don't say for, you say fur. So we're going to I'm like, you listen in.
I totally say fur. Maybe.
Yeah, there's just certain things that it just knows. And then others. When I try to type tomorrow, it says CJ. It says CJ and then some other word. And I'm like, how are they getting that from tomorrow? How bad am I at texting that's what's happening?
The predictive
right
text is not helping you out.
No.
I know. I get frustrated with them because it's so obvious.
I'm not really worried about artificial intelligence taking over yet.
No.
Because,
I'm not too concerned about that either. Oh, okay.
You and I are going to be the old people that won't get the implant in our head. Like, nope, I'm just going to stay a human. Let everybody, I'll just come live here at the cabin and don't even, no more YouTube channel. They'll just have it downloaded to their head. We don't even have to do.
That's so trippy to think about where AI is going to take the world in the future.
Yeah.
So many possibilities. Okay. Before we get into Christian's question, word of the day, principle. I think this is so important to understand the financial vocabulary in this industry, in this space, as we're learning to be more free financially. So principle, I'll just read the definition. And if you want to add something to it, you can. So when we have a loan, the original amount that is borrowed or the outstanding balance to be repaid less the interest rate.
Okay. Yeah. And then also could refer to like a amount of investment. The principle, like how much should you put in,
Okay.
Yeah.
All right. So when principal is calculated, does it take into consideration the interest and the fees being charged?
Well, when you're looking, it depends on what you're talking about with calculated. If it's an interest-only loan, there's nothing really to calculate. It's just what interest you're paying. But I think what you're asking is when something's amortized, how does that work? Because if you look at an amortized schedule, you're paying a lot more loan interest up front than you are later on, right? So you'll see a lot of people that talk about velocity banking really address and attack that. It depends on time frames do make a difference on what that is. But overall, what have you paid in interest? 5%, but it was front end loaded and started to reduce where you see eventually it's like half principal, half interest. And then eventually it's more principal than interest and so on and so forth. So
when someone's going to pay a loan, whether it's a car loan or otherwise, how can they make sure when they take their $350 payment or they turn it in, that it's going more towards principal than
the
interest?
best way to do that is get an interest-only loan, and then when you make an extra payment, it reduces the balance, and you're now charged based upon the balance, not based upon the amortized amount.
Yeah.
So if you have a 30-year mortgage that's $1,000 a month, it's $1,000 a month now, and in 15 years, and in 20 years. But the reality is you're paying way more interest in day one than you are in year 20.
Yeah.
Where when it's interest-only, you have a lot more control over that. Like I'm actually refinancing my mortgage to an interest-only loan right now. For some people, their behavior is they only pay what's required. And so they think if I go to a 15-year mortgage, I'll pay it off faster. And for some people, that may be true. And you even see with interest rates really low right now, people are barely upping their payment by going from 30 years to 15 years. So that's progress. My feeling is I like control of my money. I know I can earn more than I'm being charged right now on my interest rate. That's not through speculative things like the stock market or anything like that. It's through very stable, secure investments that we've talked about. So it really just kind of depends on your situation. But my preference has always been interest only.
Okay. That's good to know. All right. So if you...
By the way, did you ever heard of a negative amortization loan?
I don't think that I have.
So they used to have loans where you could pay like a lower payment than what your interest was being charged. They were really popular back in like 2005, 2006, 2007. And so you would actually start having your principal balance increase over time because you're not making enough interest payment.
That sounds nasty.
And it was for a lot of people because now they were upside down and then the economy changed. So they lost all their equity and then all of a sudden they're underwater, right? They owe more than their house is worth.
Right.
And so that was a little bit of an issue that kind of facilitated even more defaults. But for a responsible investor that's like really dialed in, it could make sense, but it does have additional risk, obviously.
Yeah, it sounds like it. I was going to say, why
Glad
would they?
I could teach you something new today, Stella.
Always. I'm always learning something when I'm around you. Okay, so let's dive into Christian's question. And this is what he has to say. My question is regarding how to reduce debt quickly. I make about $180,000 a year. I live in California, and I just recently found myself in the hospital from an anxiety attack. This has been super scary for me since I've never experienced it before. I have a $3,600 a month mortgage, 3 car payments, not including a couple of credit cards and other expenses. Thanks for your help. And so Christian's just wanting to know, how do I reduce my debt?
Well, first, I want him to pay attention to the 4 C's, which is what's your credit score? Get that above 760. And it's not as much about the score as having a really clean report. Look for errors. Look for, your utilization rate of those credit cards that he mentioned. Make sure that they're reporting your available balance and it doesn't look like they're capped out because that could lower your credit score. If you're above 760, then go to the second step, which is if you can refinance anything that has collateral against it, you can pay off your non-collateral loans with a much lower interest rate. So if you have a car loan or a mortgage and you refinance those to pay off these credit cards that he's talking about, that could substantially reduce your payment and the interest rate that you're paying and therefore help you out. The third C is basically your cash flow reporting, just making sure you have your financial house in order, right? Making sure that you look good to a lender so that you can get the best loans. And then the fourth is the right connections. Certain lenders lend better to others than they do to like business owners. Sometimes have it more complicated because their income's more volatile. They do major write-offs, but he has a $180,000, mortgage here that's a W-2 or not mortgage, salary that's a W-2, which is helpful for these things. The second piece here is to look at your cash flow index. So take your loan balance of each individual loan, that mortgage, those credit cards, the car loans, whatever and then you just divide it by the required payment. What do you have to pay on it every month? That's going to spit out a number. I only want him paying extra to the one with the lowest cash flow index. That's going to free up a boatload of cash flow, or it's going to be the thing that he can get momentum and get there faster with. You don't have to worry about the interest rate. It's considered in the calculation. It's just not the only calculation. And then that's going to help you to pay that off. And then that cash flow gets freed up, which will reduce anxiety.
Yeah.
Then the next thing is really focus on the 3 R's. The first R is the restructure of loans, which I've been talking about here, right? But part of restructure could be lengthening some of the loans so that you have less outgo and more control of your money. Now, here's the deal. Most people, the way our minds work is we go, if we lengthen the loan, we will have the loan longer. And the institutions want you to think that way. But instead, think of it as I have more control over my cash and I could pay that off when I choose.
Yes.
And I have cash on the side in case there's a job change or anxiety that puts you in the hospital for extended periods of time. You've got cash that gives you staying power. So it's not just restructuring from, collateral loans and paying off non-collateral loans. It's even the length of those loans that help you to improve your cash flow and then using the cash flow index in coordination with that. Now, another thing is reallocation. So if you have any investments that are underperforming, too risky, that you don't feel comfortable with, you could always use those to pay off higher interest rate loans. Those higher interest rate loans gives you a guaranteed savings and improves your cash flow. So that is a way that you could accelerate it. And then the third thing would be, the third R is renegotiating. So multiple credit cards here. Have you called to ask for better interest rates? Have you called to look at balance transfers? Have you told them that you're looking for their best deals so that you don't leave them as a customer? And so if you can renegotiate, that's also helpful. So, those are just a couple pieces, but I think it's important to understand the context of there's 3 ways to really deal with this. One that most of the pundits will say is you just live off rice and beans and you pay this off by budgeting. But budgeting, and the studies are in from Time Magazine, it doesn't work because people not only don't stick with it, they rebel against it and eventually spend more than originally anticipated. So it's really been a very problematic situation. The second thing is to be more efficient. So I would really look at, can you save on tax? If you're getting refunds from the government, change your exemption so you have that money to start paying off loans today versus giving the government an interest-free loan, right? Could you save on interest through some of the strategies that we talked about? Are there any investments that you can minimize expenses or use to pay things off, like I mentioned? Or do you have duplicate coverages or costs with insurance that can allow you to get money to pay off these loans? So I'm looking for efficiency too. And then the third thing is expand your means. So you can live within your means by budgeting and cutting back, being efficient, or expanding it. So how can you make more money? Have that question. How do you add more value? How do you serve more people? How do you more deeply impact the people you serve? How do you create upside potential in what you do? Those are going to be ways that help you to accelerate the payoffs here. And then really look at unique and different loans. I mean, is there any type of loan that you could get that came out with the CARES Act? Is there anything that you could do within family members where you can give them a better interest rate than they're getting in the bank, but you get a better interest rate than the bank's giving you? And so you just cut out the middleman and do an intra-family loan or an intra loan that kind of helps out and do it privately. So those are a lot of pieces that I think are really helpful if you want to pay something off quicker.
Yes. One question that I have that might be helpful to Christian is, can you define debt? Because there's some confusion around what debt really is. Even
when people don't think they're confused about it, they're not defining it right because people have, I don't know, whether it's marketing, whether it's misinformation, like people think anytime they owe money, it's debt. But debt in generally accepted accounting principles, GAAP accounting, is when we take a balance sheet, which is just your assets versus your liabilities, right? It's kind of like what tells you your net worth or your equity or your debt, because the opposite of equity is debt. So if I have an asset that's worth $100,000 and I have a loan that has $50,000 against that asset, most people say I'm $50,000 in debt. It's actually the opposite. They're $50,000 in equity because if we take the 100,000, subtract the 50,000, that's 50,000 of positive equity. Yet everybody calls it debt. And if we're thinking you got to avoid debt like the plague, then we feel this major burden. And then people start quoting the Bible of saying like the borrower is a slave to the lender and all this kind of stuff. It's like, okay, well, let's be really clear. Like it depends on who you are, what you can do with those assets, what kind of cash flow it's providing. But let's be clear, there's difference between debt and loans. And loans can either be inefficient or ineffective or efficient or effective. So if it's ineffective, it's if we borrow money, we consume, and we no longer have an asset to show for it, that is going to lead to debt, right? And then secondarily, if we borrow money and we have a major payment against that money because of high interest rates or short terms, that's a very inefficient loan that can really tear up our cash flow. So an efficient loan is a cash flow index under 50, loan balance divided by payment. Or less than 50 is inefficient. Efficient is greater than 100. And there's kind of like that no man's land between 50 and 100. Okay. So that's important to understand. Debt isn't just owing someone. It's owing more than what you have. Now you may still want to never have a loan, and that's fine because maybe it doesn't allow for peace of mind. Maybe it starts to stress you out, or maybe, people live outside of their means because they have access to money for cars and houses. Like if we didn't have lending on houses and cars, they would be less expensive and less people would be in trouble because those are not assets that typically create cash flow. Sure, you can use the Turo app with your car and rent it out. Sure, you could Airbnb your home or VRBO or any of that kind of stuff, but most people don't. So they think it's an asset, but assets that don't create cash flow are not truly assets until they can actually impact your income statement when you have more income than expense. For most people, those are expenses, but they're lifestyle expenses. I'm not saying to avoid them, just be mindful of them.
Yeah, I think this is a good point, like especially since Christian shared that he was feeling anxiety. We don't know what the cause of it is, but if it's around money, I think it's really important to understand the difference between a loan and a debt and if those things are bringing you anxiety because you feel pressure or you're not someone who likes to have a loan or, you're feeling overwhelmed by it. So I think that's a good place to start exploring how can we experience more peace and abundance around money. And so I'm glad that you clarified the difference between the two.
All right. We covered quite a few things today on how to, accelerate the payoff of loans that are unwanted. And if you really want more on this, budgetingsucks.com has several chapters on how to address this, but it also says where to put your money when it comes to savings. It also talks about your investor DNA so you can become a better investor. It talks about ways that you be more efficient so you can keep way more of what you make without having to budget or cut back, and learn about mindful cash management, which gives you more freedom and allows you to think more about production rather than trying to shrink your way to wealth, which really doesn't work. Want to master your money? Want to figure out the things that you could do to improve your finances? Click here and check out more videos like this on Money Matters.